Welcome back. It is time for Forum Daily's weekly energy update with Dan McTeague, Senior Petroleum Analyst at GasWizard.ca. All yours.
Well, thank you very much for that, Nima. And what a couple of weeks it's been. The markets are really in a bit of a tug of war. That is the energy markets. You have on the one side pessimists that believe that there's an abundance of supply, there's inflationary pressures, the Friday decision by the U.S. Fed as to whether it's going to raise interest rates. Overall concerns about inflation, I think, have a lot to do with why we've seen prices drop as dramatically as they have. And if you look on average since the beginning of June, we're down about 60 cents a liter. That's something that most would never have imagined possible. But all this really is short-term gain, long-term pain. The dramatic drop in price, very welcomed, is nevertheless going to increase demand. More importantly, especially on the diesel side, reflecting what's happening in Europe with the shortage of natural gas, watch out for September. The other side of the equation is the supply picture. Supply picture for diesel, supply picture for oil, supply picture for heating fuels and jet fuel. All those things are in very critical, in a very critical position right now. So the landscape is one of some traders saying, "Hey, we're going to, shed our positions," while reality is that we are at a very dangerous level in terms of global supplies. Yes, there's the issue of Iran, whether they'll be allowed to come back in and pump oil, whether the United States will accept that. But we have now evidence from OPEC, especially Saudi Arabia, saying if Iran is allowed to come back in and if markets continue to be dysfunctional, which I believe they are, we're going to chop back the amount of oil production. What that means for Canada is that gas prices that we're seeing in the $1.90 range in British Columbia this week will probably stabilize, maybe go up 3 or 4 cents a liter. For the prairies, they will continue to drop. So we'll see Calgary and Edmonton in the 140 range, maybe even the 130 range. For neighboring Saskatchewan, Manitoba, you're still looking at $1.50 to $1.60. Winnipeg's extremely high, and that does have some cause for concern. Retailers are doing extraordinarily well there. They should be dropping prices. Ontario, you'll continue to see prices in the 154 to 156 range, likely up about 2 to 3 cents net this week, certainly by the end of next week. And then, of course, for the Maritimes, Quebec, staying in the $1.90, $1.85 range. Actually, you can buy gasoline in Montreal for about $1.75 right now, so they may push back up to $1.80. For the Maritimes, again, looking at some pretty big decreases this week, but that's not likely to last, as we might see markets move back up a little bit this time next week, next Friday and Saturday. So what that really means is that across the country, we are looking at policies that give the appearance of things going well. The Canadian dollar is extraordinarily weak, continues to remain very weak, and no announcement by our federal government to come to the rescue of Europe with respects to additional natural gas or the building of LNG. One would have expected that would have been a decision by the federal government along with the German chancellor. He goes home empty-handed, facing a very grim, very cold winter, while Canada continues to virtue signal on this idea that you can somehow get rid of natural gas. Look, the world is moving ahead of Canada, and if we continue down this road, you'll have not only a weak dollar, you'll have very little in the way of investments, capital coming from around the world to invest in Canada. You can't continue to live on borrowed money and subsidies for EVs, for solar panels, for hydrogen, and of course for wind power. We know that the cost of living is rising in Canada, driven by energy, most importantly, driven by woke energy policy that is having the effect of making life very unaffordable for Canadians. I'll have a little bit more to say about that next week, Nima, but in the meantime, I think the focus, if you go to my site, affordableenergy.ca, or if you look at what some of the work we're doing at GasWizard.ca, that's the site I run that predicts prices, you get a pretty good idea of where I think this is really the proverbial calm before the storm. There's going to be a significant price to pay by Canadians this winter, and unlike many other falls and winters where you often see prices drop, I expect prices to go up at least another 30 to 40 cents a liter for diesel and for gasoline. It won't be helped, of course, by the federal government adding another carbon tax next April, and in about a year and a half from now, the real effect of the clean fuel standard, which is really to mix more ethanol into gasoline. At the end of the day, all these things point to one direction, less driving and a higher cost for just about everything. We'll talk next week, and have a little bit more on that to say. Thanks, Nima.
Lots to keep our eyes on. Thanks for that, Dan. Again, that was Dan McTeague, Senior Petroleum Analyst at GasWizard.ca. He is also the president of Canadians for Affordable Energy.